Hi, I'm Chloe Carruthers here with Barry Norris, the manager of the Argonaut Absolute Return Fund, here for our February update. Barry, it was a tumultuous month with the markets. How did the fund perform and what were the main drivers of performance?
Well, in another tumultuous month, Chloe, the fund delivered just under 4%, which means that we're up nearly 10% for the year now and 65% over the last 3 years. I think what was really pleasing this month is that the long book actually contributed most of the positive return, in particularly commodity producers and especially the fertilizer companies K plus S, which was up 35%, and Canadian company Mosaic, which was up 27%.
How did the Russian invasion of Ukraine affect the fund?
So at the beginning of the month, we closed all of our Russian positions, both long positions and short positions, because we were concerned that sanctions against Russia would lead to both GDRs on the London market and ADRs on the US market being suspended indefinitely. And that would lead to problems both in dealing and valuing the funds. So the funds weren't directly impacted, but they were positively impacted indirectly through our bullish positions and views on commodities.
What are the consequences of Russian sanctions on the global economy?
That's a good question, Chloe, and one that I think a lot of fund managers are thinking about at the moment. So the economic fallout from the crisis is likely to see Russia disengage further from the global economy, which is bullish for our commodity positions, particularly in energy, where Russia supplies about 10% of global oil and gas, but also in commodities where Russia has big market shares, such as agricultural commodities, potash, for example. Russia and Belarus together are 40% of the global market, and also industrial metals like aluminium, nickel, platinum, and palladium, where Russia also has very big market shares. So these commodity markets were already tight before the prospects of Russian sanctions, and now we just think they'll be structurally underpinned by Russia's exit from the global economy, which is probably likely to last years rather than days.
Cathy Wood said last month that her funds are investing in innovation, which is the future, whilst fund managers investing in old economy industries are investing in the past. Are you misallocating capital to sunset industries?
Well, we certainly agree with Cathy Wood that there has been a misallocation of capital, but the misallocation of capital has been to the speculative bubble in innovation. And I think if you look throughout stock market history, from the invention of the railroads, every innovation cycle eventually turns into a speculative bubble. Now, we think that this almost exclusive investment period or exclusive bull market in speculative technology has actually prevented the West from allocating capital to commodities, which are needed both to maintain our standard of living, our energy security, but are also, of course, essential to those very products, to manufacture those products which are supposedly going to be less impactful on the environment. With the end of free money, investment has suddenly become a lot more complicated than handing out free capital like lollipops at the school fete to anybody with a business idea like flying taxis or carbon-free hot dogs. So like the end of the previous decades in growth stock bull markets, the go-go stocks of the 1960s or the dot-com bubble of the 1990s, complacency and lack of experience of anything else means that most people are unable to recognize the sea change in the macro regime and the fact that the investment rules have changed. And as we've seen so often, the heroes of the bull market turn to bear market villains. The West thought it could just move commodity supply off its own balance sheet. Putin's power is derived from owning strategically important commodity assets that have become scarce because of the West's underinvestment. The Ukraine conflict, therefore, I believe, is highly symbolic of the new hegemony in commodities over other asset classes. This will be very much like the OPEC crises of the 1970s.
Does the Russia-Ukraine crisis change the pace at which central banks will exit from QE and zero interest rates?
Well, I think we've already seen the ECB use it as an excuse to push back their exit from asset purchases until the summer. But as for the world's most important central bank, the Federal Reserve, they can't really use it as an excuse to delay their exit from extraordinary stimulative monetary policy. Remember, the Federal Reserve is still making asset purchases and still hasn't raised rates. So perhaps it means that we're going to get 25 basis points increase rather than 50 in March, as we predicted in December. But I really think it means that probably that we get higher inflation for longer, and therefore the terminal interest rate, which I think the long-term interest rate, which is very important in your assumption in equity markets for valuing stocks, will probably be higher rather than lower as a result of this crisis.
What would you say the fund offers investors, which most other equity funds do not?
Well, I think we've demonstrated again that the fund is able to still thrive in difficult equity markets, and therefore is not dependent on market direction like 99% of other equity funds. So it doesn't mean to say that we'll always do well, but it does mean that our successes and failures will happen at different times to most other equity funds, and therefore the fund not only provides attractive returns, but great diversification benefits. And I think that that is the most important thing that the fund can provide in people's portfolios. But we've been saying for the last 6 months that the outlook for most asset classes, apart from commodities, is significantly deteriorating. And in fact, we've predicted a return to the 1970s, where most assets struggled to keep up with inflation, and it really was a commodity-led bull market. And therefore, whilst we don't believe in forever trades, we think that the fund is relatively unique in providing a hedge on this prospect of a return to the 1970s. And although we suspect that not everybody will agree with us, it is something that I think everybody should be agreed on, that it might be something that it should be wise to hedge against at this time.
Great. Thank you very much for your time.
Thank you, Chloe.